I'm telling you to be hedged in this crazy market. However, when you're hedged, your hope is to lose money on that hedge. This market is crazy. We are 10x over the last 15 years. And even crazier is the dividend yield. Look at these lows, similarly to the 2000s, also similar compared to history to the 1960s and also to the 1929s. All these times, the stock market had terrible returns in history. I hope it doesn't happen, but if history just rhymes, sooner or later it will happen. So you have three options, and I'll discuss each one separately in a video. You can be in cash like Berkshire. You have diversified value portfolio that we'll discuss tomorrow with 5 stocks that I own there, examples, and you can be hedged. What is hedging? How to hedge today? You hope to lose money on that. And what is cost-effective hedging are the topics of today. So if you just ask smarter people, the core idea of hedging is that you take a position that will gain value if your main portfolio loses value. Derivatives-based, put options, futures, forwards, things like that. Not 3x leveraged ETFs. Those are made to go to zero. Those are huge decay. Those are terrible. Forget about that. That's betting. And I have discussed hedging, how you need to think about hedging, especially if you have a pension fund that's long everything else, the S&P 500, AI, things like that. Perhaps a hedging strategy might be good. Of course, if nothing happens and the market still goes up, this is over the last few days, but there is decay with your options, and if you pay whatever, you hope to end with zero in a year. Now, how much does it cost to hedge? If I want to protect for a year and something more, I have to pay around 40 for a put option on the SPY ETF here. So for 14 months, I am 5.9%. So 5.5%, I buy a put, and whatever happens with the market, I am at zero. Of course, I hope to lose those 5.5% because those 5-6% allows you to be 100% long with whatever you have in your portfolio. And now the question is, okay, but then if the market goes down, I don't know, 20% like here or 10%, do I have to sell my option, buy back? No, I'm discussing hedging, not gambling on options on those short-term declines. I'm saying I invest 6% in the put option. If the market goes up 17%, my return is 11% for sure. Maximum loss is 6%. That's the maximum downside your portfolio has. The upside is whatever the bubble does. You are not trying to gamble on this because then you just become a gambler, option gambler, and then you're sure to lose your edge. If you want a hedge, you buy it and you just forget about it, you hope to lose money on it, and then you see where the market goes. When it hits a fundamental value that you like, perhaps you don't like the 1.2 dividend now, you like 1.7 dividend, then you can close your option, buy more of the market, and enjoy your wealth and retirement with the 1.7 dividend. That's sarcasm for those who don't know when I'm sarcastic, when I'm not. So when you try to be smart about options, you are an option trader, gambler. That's not the point here. We're talking hedging. However, there is hedging and there is cost-effective hedging. Just buying a put, some say it is too expensive and it's comfort, it's not real protection. And that's my favorite book author, Safe Haven and the Tao of Capital, Mark Spitznagel. I'll put these videos in the links in the description below. And here he says, most hedging is too expensive because if you just buy a put option, it decays, the cost is too much. You need cost-effective hedging, costs very little during normal times and pays off massively. That's asymmetric convex hedging. How do you do it? You buy those tail hedges that are there around. However, I'm not a specialist, but if you spend 3 months on that learning, I think you can know to perhaps hedge at the same cost or a little bit less costly, but depending on how much fun you want to have it. Because this only pays during huge tail events. And Spitznagel calls option hedgings more for comfort. But if you are heavily invested in everything that's going on now, you might also want to hedge for comfort. It's your decision. You don't have to maximize. You have to not lose your millions, not try to make from 5 7. Not losing is the key here. Prudence. You have to make a personal decision. That's something I see a lot of people struggling today. If you're already rich, why risk what you have for more? Just to maximize, because Wall Street caters to that overperformance of yours. Oh, we can do a little bit better here. They get their fees, you are invested, and they don't care about your money. They care about their money. So you should be the person that cares about your money. You do that by thinking about prudence. Perhaps hedging is one of the free options that you might want to use. However, if you need hedging, you might reconsider what you are being long, and we'll discuss that more tomorrow.